Welcome to this explainer. Okay, today we're uncovering a true masterclass from a guy who is highly successful, yet somehow almost never discussed. You know, when we think of GEICO's insane financial success, pretty much everyone immediately thinks of Warren Buffett, right? But behind the scenes, there was this quiet outperformer literally pulling the levers of GEICO's massive investment portfolio for over 3 decades. And the returns he generated, frankly, they're hard to even comprehend. We're talking about Simpson. We're going to break down his exact, totally contrarian strategy and uncover the core principles that made him an absolute legend. Let's just dive right in with a massive endorsement. Back in his 1982 letter to shareholders, Warren Buffett explicitly stated, "In Simpson, GEICO has the best investment manager in the property casualty business." I mean, just imagine having the greatest investor of the modern era call you the absolute best in the business. No way Buffett hands out praise like that lightly, right? That alone should tell us we need to pay very close attention to how this mystery man operated and what made his mind tick. So, Section 1, GEICO's quiet outperformer, Simpson. Let's set the stage for how he actually operated within that Berkshire Hathaway universe. Seriously, picture this. You have the greatest investor of the modern era as your ultimate boss, yet you operate with such total autonomy that he doesn't even know what you're buying until 10 days after the month ends. Simpson joined GEICO in 1979, which was just a few years after Buffett made that crucial lifeline investment to save the company. But despite the towering presence of Buffett right there, Simpson maintained a completely independent investment process. Actually, Buffett even admitted he sometimes silently disagreed with the decisions Simpson was making, but he noted that Simpson was usually right. Having that level of independence and the immense conviction to trust your own gut with the world's most famous investor looking over your shoulder, that is a huge part of what made his long-term success possible.
Moving on to Section 2, breaking the industry rules. Let's look at his completely different approach.
And what we're looking at right here brilliantly illustrates the contrast between a true visionary and, well, the herd. You've got to remember the brutal economic environment of the late 1970s. It was this era defined by stagflation. High inflation mashed up with high interest rates. Traditional insurance companies were terrified. They were taking these massive losses on their bond-heavy portfolios, and they capped their stock exposure at 10% or less, just clinging to this perceived safety. But Simpson, he saw an entirely different landscape. He confidently allocated up to 45% of GEICO's portfolio into stocks. He was fully willing to deviate from industry norms because he recognized that carefully selected equities were actually a way better hedge against inflation than those dying bonds.
So the really crucial point here is how he managed the perceived risk of having so much capital exposed to the stock market. Well, he did it through radical concentration. He systematically stripped down the portfolio to focus capital only on his absolute highest conviction ideas. When he started, GEICO had about $280 million spread pretty thinly across 33 stocks. But over time, he ruthlessly pared that down, eventually keeping the whole portfolio to just 8 to 15 holdings. Just think about the psychological difficulty of that. By 1995, he was managing a $1.1 billion portfolio, and he held just 10 stocks. He firmly believed that if you truly want to add value to the investment process, concentration isn't just an option, it is a strict requirement.
All right, Section 3, Simpson's core investment principles. Let's crack open the strategy.
This right here is the framework. It looks pretty straightforward on paper, but trust me, it's incredibly difficult to execute with actual discipline. Let's walk through these 5 pillars deliberately. First, think independently from the crowd, which, as we just saw, he totally did by ignoring those terrified insurance industry norms. Second, invest in high-return businesses run for shareholders. He specifically hunted for companies that treated capital respectfully, like aggressively repurchasing their own stock when it was undervalued. Third, pay a reasonable price. You can't just buy a great company. You absolutely have to buy it at a sensible valuation. Fourth, invest for the long term. Keep turnover remarkably low and let compounding do all the heavy lifting. And fifth, actively avoid over-diversification. He basically recognized that adding your 30th best idea to a portfolio only dilutes the power of your top 5 ideas.
Let's zero in on that third pillar for a second, paying a reasonable price. When it came to finding that exact entry point, Simpson was obsessed with one specific metric to ensure he wasn't overpaying: price to free cash flow on a per-share basis. He wasn't getting distracted by abstract Wall Street accounting or manipulated earnings reports. Nope. He wanted to know one simple thing: exactly how much actual, usable cash is this business generating relative to the price of a single share. Cash is reality, right? And free cash flow was his ultimate truth serum for valuation.
Section 4, putting principles into action. Let's look at some real-world case studies.
So he applied these principles to find overlooked, misunderstood value in the market.
Two fantastic examples are the Baby Bells and Freddie Mac. Back in the 1980s, the government forced the breakup of the AT&T monopoly into regional telephone companies, the Baby Bells. The broader market absolutely hated the confusion and just dumped the stocks. But Simpson used his independent thinking, saw these highly profitable local monopolies basically printing cash, and he bought heavily. Then, with Freddie Mac, he found a stock that lacked institutional coverage, was relatively illiquid, and heavily ignored. Because he was willing to look where Wall Street wasn't looking, he bought in at just 3 to 4 times earnings. That single conviction play ultimately generated massive 10 to 15 times returns for GEICO. I mean, wow.
Now, the rigorous execution of his famous Nike trade perfectly illustrates this discipline. Nike eventually grew to become about 16% of GEICO's entire portfolio, but the entry and exit, those were governed by strict, unemotional rules. Step 1, he initiated the position when it offered an 8% free cash flow yield. To Simpson, an 8% yield meant a massive margin of safety and a business generating serious cash. Step 2, he would only add to the position when it hovered around 13 times earnings. And step 3, he would systematically trim the position as the valuation stretched closer to 20 times earnings. It was this completely unemotional, highly calculated process, based entirely on his core valuation metrics. And here's a crucial takeaway for any investor out there. The numbers matter for sure, but management matters just as much. Simpson spent a massive amount of time assessing leadership, specifically looking for high integrity and a flawless track record of capital allocation. He actually built a relationship with Nike founder Phil Knight and gained incredible confidence in him. He particularly loved that Nike was run conservatively. They showed incredible restraint by avoiding those reckless, ego-driven acquisitions that just destroy shareholder value. He wanted management that acted like true owners, and Phil Knight fit that bill perfectly. Section 5. The power of doing less. Let's talk about some extraordinary returns.
The result of all this discipline is nothing short of legendary. Over a quarter century, from 1980 to 2004, Simpson generated an average annual return of 20.3%. Now compare that to the S&P 500, which returned 13.5% over the exact same period. He crushed the broader market by nearly 7% every single year for 25 years straight. In the world of institutional investing, that level of sustained outperformance is phenomenally rare. It is literally the holy grail of compounding.
To put that compounding machine into perspective, let's look at the raw wealth creation. Say you had invested $100,000 into the S&P 500 in 1980. After 25 years, you'd have about $2.37 million. Honestly, a great return. But if you had invested that same $100,000 with Lou Simpson's GEICO portfolio, you'd have roughly $10.15 million. That additional 6.8% annual return compounded into nearly $8 million of extra wealth. That is the true, life-changing power of his concentrated strategy. It's just wild.
Simpson himself perfectly captured the secret to this massive outperformance. He stated, "We do a lot of thinking and not a lot of acting. A lot of investors do a lot of acting and not a lot of thinking." His approach proves that extraordinary results don't come from frantic day-to-day trading. Actually, activity is often the enemy of returns. Real success comes from doing significantly less, but doing it with infinitely more depth and conviction.
He expanded on this whole filtering mindset by noting that a record is built just as much on the investments you decide to reject. Think about how difficult it is to just do nothing in today's world. We're bombarded by daily trading apps, constant notifications, and this nonstop pressure to constantly optimize. But Simpson, he would sift through a massive number of ideas and basically say no to almost all of them. He recognized that you truly only need 1 or 2 great decisions a year, provided you size those positions correctly and have the patience to just sit on your hands. So, as we wrap up this explainer on the legendary Lou Simpson, I want to leave you with this question. How can you apply this disciplined power of filtering and doing less to make better, more concentrated decisions in your own life and investments today? Remember, the core principles of investing haven't changed. Extreme discipline, aggressive selectivity, and independent thinking will always win out over frantic activity. Thanks so much for joining me to uncover this incredible masterclass, and I'll see you in the next explainer.